Hello, everyone. Welcome to the last video of Chapter 1, Module 1. We're going to just look at some preliminary principles of tax planning now that we know some things about net income. So sharing my screen. Principles of tax planning. There's the one principle of wanting to save money on taxes is tax avoidance or reduction. So to permanently avoid payment of some amount of tax. So this allows us to earn income, but save money on the tax payments. Limited possibilities, capital gains deduction on qualified farming or fishing property, qualified small business corporate shares. We talk about this more in a later chapter. I think chapter 8, we touch on it. Um, if you have a qualified small business, normally a Canadian controlled private corporation, the government wants to reward entrepreneurs who start new Canadian businesses. So when you sell a Canadian business, a certain amount of the capital gains are protected from taxation. So you can have this large income, and I think they can protect up to $1 million of capital gains. So you might have this big payday, and you won't have to pay taxes on it. So that allows us to avoid taxes, just a tax amount you never have to pay. Private health care, if your employer provides healthcare premiums that you don't pay for, that is a benefit to you, but it's an amount that doesn't have to be included in income, and we'll talk about more on that in chapter 3. And then employee discounts on employers' products is another item we'll talk about in chapter 3. So there's these limited ways that a person can earn benefit, earn money that don't have tax implications. So other sophisticated and complex tax planning involve trusts, partnerships, private corporations available in order to save taxes. So like private corporations, corporate tax rates are generally lower than individuals. So if you want money left over in order to reinvest in your business, incorporating is a good way to avoid certain amounts of taxes. For the individual, well, a great way to save taxes is to tax defer. So you defer your taxes to a later date. This is to pay taxes later rather than sooner. And because of the time value of money, I'm going to have to pay $1,000 in taxes. Paying $1,000 of taxes 10 years from now is better than paying $1,000 in taxes today. So the biggest example of this is the RRSP, our registered pension plan. That allows us, so when we take $10,000 and we put it into an RSP, we get to subtract it from our income, and we don't have to add it back to our income or pay taxes until we pull it out of that registered account. So that allows us to put money into savings, defer the taxes until we retire or until we pull the money out at a later time. So we're going to pay that same dollar amount of taxes, but paying it 10, 20, 30 years down the line is a much better financial outcome for the individual. There's also expense acceleration. We'll talk a bit more about CCA in chapter 5, but the idea is claiming larger expenses this year will allow you to defer more taxes because taxes are based on net income. So if you have expenses that travel over several years and you have an opportunity to correctly report more expenses in the current year, that will reduce your taxes. It will have less expenses available for next year, so your income will increase by the difference. So you'll pay more taxes, but saving taxes now to pay those increased taxes later probably still has a financial benefit to you only because of the tax deferral. Even though the dollar amounts are the same dollar now than later is worth different. So tax deferral is a great way to handle tax planning. One of the best ways to avoid or defer taxes is income splitting. Because Canada's rates are progressive, the higher your income, the higher your tax rate. If I can take my income, split it in half with my spouse and I will both pay a lower tax bracket. So a smaller percentage of income will be taxed or will be taxed at a smaller rate. So this will save us taxes. If we put all of the money in my hands, we're paying a higher tax rate. But by sharing the money, our family unit has the same amount of money available to them, but overall less is going to be taken by taxes because we're being taxed at 33% instead of 40% on the amount. So income splitting is one of the best ways. And so when families own businesses, they often have multiple family members as shareholders because then they can split out employment income, dividend income, etc. Um, so the government has a lot of rules around income splitting, and they're called TOSI rules, tax on split income, to make sure that the individuals who are having their income split are involved in the business, are contributing, and it's not just a tax avoidant plan. But if you can find opportunities to split your income with multiple family members, you will save taxes. There are also rules that allow people enjoying pension income to split that income with a spouse. So if you earn pension income and your spouse doesn't, and you're both retired, you can take that pension income, put some of the income on their return so that the two of you can save money that way. The thing about splitting your income is you often have to lose control over assets. In order for your family member to earn dividend income, you need to provide them shares. You need to provide them some aspect of control over your company. So, along with this splitting income, you do lose a bit of control. That control means decisions of how much and which family members are worthy of receiving benefits, depending on their contribution to the business. And the Tax Act has anti-avoidance rules where they specifically look at family and non-arm's length involvement in business to make sure that tax split is reasonable and fair. Okay, so going to these two exercises. Mr. Stephen Chung has decided to make contributions to an RSP in the name of his spouse, the mother of his children. Rather than making contributions to his own RSP, what type of income tax planning goals are involved in this decision? The other one is Mr. Green's employer pays all of the premiums on a dental plan that qualifies as a private health service plan. The plan covers Mr. Green and his family and benefits him since he does not have to pay the premiums. What type of income tax planning goals are achieved by this benefit? So we have two benefits to talk about. One is the contribution to a spousal RSP. We are taking part in tax deferral. He's going to get a deduction from his income for the amount he's put into an RSP plan. So he's going to save those taxes now, and those taxes won't be paid until they're withdrawn from the account. They're also going to be withdrawn into the spouse's hands. He didn't put it in his account, he put it in his spouse's account. So though that income is going to be taxed in his spouse's hands instead of his own, so we have some income splitting. If the spouse is in a lower tax bracket at the time of withdrawal, then that means that we're avoiding tax. So, sorry, just blanking on his name. So if Mr. Chung is in a higher tax bracket, if he had kept the money, maybe he's paying that 40% taxes. But when it's taken out in the spouse's hands, if she's in a lower tax bracket, they're not paying 40%, they're paying 33. So they saved 7% on the income. They saved 7% worthy of taxes. So we have both tax deferral and income splitting, and those two combined to make this tax avoidance. The employer paid dental plan is an example of tax avoidance because it's a benefit to the taxpayer. I'm receiving a benefit. Someone is paying premiums for me, but I don't have to report it as income. So I'm able to receive that benefit and avoid paying taxes. If they paid me the money and then I paid the plan, then that money received will be included in income and I will have to pay. But I don't want to pay those taxes. I want to avoid them. So the employer can pay the premiums. The money never touches my hands, so I get the benefit without the income inclusion. Therefore, avoiding taxes. So that is our last video of chapter 1. Hopefully it's covered enough. Hopefully it's easy to understand. If you have any questions, always feel free to message me. The quiz, I believe, is usually opens by the beginning of the second week and is available for a while, but keep an eye on those due dates. Make sure you take the time, review the course material, handle the quiz, and I will see you in the next chapter. Thank you.